Welcome, Pat. Welcome and happy Wednesday, not
Yeah,
happy
happy Wednesday, day
Thursday.
before. And I guess you got your big birthday tomorrow, so we're on tonight.
Yeah, I
Welcome,
actually,
everybody. Welcome, our millions of viewers.
millions of viewers, I actually forgot. I told you, yeah, we do. But yeah, we'll do Thursday. Hung up the phone. I got thinking, I go, oh, no, wait a minute. My boys want to take me out for my birthday. So, anyway, the things that happen when you get older. So today was Fed Day and Fed Speak Day,
Yeah.
and gonna lower it by 0.25 as expected. And in the past, whenever they've had the rates go down, their overnight rate, our mortgage rates went up. Not the case today. Why is that?
Well, I think, it's kind of funny. I mean, I think I think it's the last five meetings they've been going down, like just like you said before the meeting. And then everybody's like, well, after the meeting, it just catches everybody by surprise. But today, you look at if I could switch, you show my computer. I mean, the last, you look at the 5% coupon, right? This is going back, this meeting right here, September. This is just before the meeting, right? Bonds were doing well. Prices were going up, meaning rates were going down, right? Well, then this is when they announced prices went down, rates went up. That was the September meeting. And it happened just in October too. You look at right here, rates were getting better. Then all of a sudden they got worse. But this time, rates were getting worse. If you look at this is prices. So this is inverse to rate. These are bond prices. So basically, as these were going down, rates were going up. So today it was direct opposite what we've seen the last couple of meetings. The last 5 days, rates were going up, and today they went down. So who just
Well, he was, in addition to just saying, that they were going down 0.25, he spoke about a lot of different scenarios
yeah.
and stuff, which is why they do this after the stock market's cut. Could you imagine being a trader on the floor? Oh, they cut and buy, and they buy, and he said,
Well,
what? Sell. It'd be chaos.
yeah, I mean, bottom line is his comments the last couple of press conferences, the last couple of months, he's throwing cold water on everything. I mean, his comments were negative, just were not bond friendly. And today he kind of avoided this kind of this hawkish talk. Basically, I think he kept a little bit much more neutral.
Well, he was talking about the things that they still don't know, and he's kind of still on this horse about, it's going to take time for the effects of these kind of, why am I having a brain fart here? These tariffs.
Yeah.
Why could I not remember tariffs? It's going to take time for these tariffs to take effect because it's going to take this. So he's still right here thinking, okay, this is going to put it up. What surprised me was they revised their GDP forecast from 1.8 to 2.8. And a lot of people think that may be a little lower than what they expect. But the other thing that he said here is, this is a post meeting. He said, housing market faces significant challenges and that a 25 basis point cut won't make that much of a difference. No kidding. The housing supply remains low, he noted, and the ultra low mortgage rates that some homeowners snapped up during the pandemic are discouraging many from moving since rates are now much higher. Housing is going to be a problem, he said. Later adding that the central bank doesn't have the tools to address a structural housing shortage. Now, when he says it's going to be
I could have told him that 2 years ago that housing has been a problem.
well, what does he mean when he said housing is going to be a problem? Is he saying housing is going to be a problem? House prices are going to come down?
No, I mean, he's basically saying that it's going to be a problem for the buyer because prices are not going to come down.
He could lower prices by just raising rates to 10%, but a lot of things would break. did that.
Yeah.
So he's saying, hey, look,
Which I'm sure a lot of people would love to see that some way,
There's-
shape, or
there's-
form.
yeah, there's nothing I can do about it. I can't build houses. So here's a chart that we went over a little bit. This is our average price per square foot. Tends to go up when we get more high-end homes listed. So what I want to do is I want to show you what we're seeing in the under 500,000 range. It's kind of enlightening here a little bit. I'm going to remove all of these on the list here, and I'm hoping it's going to cooperate with me. That's 800,000, and the next bracket should be 600 to 800, and there's 500, 600. I'm going to take that out. So anything under 500,000, what's going on with our price per square foot? You can see that it's still declining. This is what you would call entry-level first-time home buyers. And thank you, Timothy. Appreciate that. And we're officially at $223. Our peak right here was $254 a square foot. So if you were to draw a simple trend line from where we were, let me move this out of the way. The case could be made that we're almost where we need to be in below 500,000. We didn't mean to draw this many red lines there, but I looked away and it took over. So,
hey, Debbie.
hello, Debbie, welcome back. So that price range getting some relief. I believe it's down about 15% from the peak. And I pulled up some other numbers here. Here's the 30-year fixed mortgage rate going back to 1998, 9.1. Kind of we're at 6.22. That's where we were in 2006. So the problem with here, 2006 and 8 range, is the rate was between 6 and 7, not high, just fine. But nobody was carrying that rate. That was the rate, but everybody was getting loans at like interest only or 1% teasers for 1 or 2 years.
Yeah.
So when that went away, they ended up paying this. They couldn't, so they bailed.
Well, and that's the thing is, I mean, they're two-year prepay. I mean, 2-year arms, 3-year, 2 and 3 years, and then so in 06, if they reset in 08, 09. But then the big problem was it was 100% financing.
Yeah.
I mean, nobody had any equity back then.
No, you could get in for zero down, and you could say that you made 60,000 a year when you only made 6, and lo and behold, you could get a house.
Yep.
And there were people shouting from the rooftop saying, "This is going to be a problem," and that's where they were ignoring it. So on my 7-day moving average, that's what I'm kind of moving around here while I got you on here, is you can see that everything's coming back up post-holiday, Thanksgiving. So our sales are going to get to about 2,700 and stay there again.
Mm-hmm.
New listings are still below new contracts, and that's going to be that way till the first of the year. So that is not pricing pressure on the downside. That's actually pricing pressure on the upside. Here's where we're at with pending listings, Pat. We are right where we were the past 2 years. No movement whatsoever.
It almost looks like a mirror. I can't believe how those lines are just almost mirror images of each other.
Yeah, it just look at that. Boom, boom, boom. I mean, a little bit of difference here when you got to the summertime, but that's only going back to 2023. But 2024, it's almost like, don't buy a house until you phone ahead, see where we're supposed to be. So no changes there. So here's the big question. It came out on Market Watch today, and I know you get hit with it a lot, Pat. Should you refinance your mortgage now? This could be the last rate cut for a while. What do you think of that headline?
It's kind of stupid because mortgage rates really are not reflected in the federal rate cuts. I mean, we could not have another rate cut for another 3 months, but certainly we have seen it where rates have quietly, back in this last couple of years, we've had it where there's been no news on federal rate cuts, but rates quietly went down 2 or 3 months, or quietly went up, I wouldn't say quietly went up, but quietly went down from really this May. Remember, they were at 7 and 1/8 in May, and quite quietly we saw 6 1/4, 6 3/8.
Well,
So
and but again, this underscores, the news and the headlines. They're always pointing towards the Fed announcement and the Fed rate cut. I mean, I have friends that call me going, "Hey, what do you think's going to happen?"
I
They're
know
lowering rates, and so they
we
think their
could
mortgage is going to go down. It's like it
we
already
could
went
we could
down.
probably we could probably do a podcast every day from now till infinity just to say, hey, federal rate, the federal rate cut does not have anything to do really with mortgages. We should do one every day, maybe at 8 o'clock every morning, just put out a PSA, just a reminder,
A YouTube,
I
a
mean,
YouTube short.
our YouTube reel. But I mean, the bottom line is that mortgage rates are based on the 10-year treasury, and that trades every day based on the daily news that's out there, day to day, week by week. So there could be something, that headline is really just kind of stupid because there could be something 30, 40 days from now that basically pulls, the 10-year treasury has some influence on it, and all of a sudden you've got it down. If we see the 10-year treasury at 3.8, 3.7, 3.8, you're seeing rates will be into the high fives. So, and the problem is with a lot of people, probably Debbie including, there's people out there that are looking to refinance. They've come down, but they just haven't come down to the point of like where I could do pom poms and say, hey, I'm saving you a good chunk of money. They've come down from 7 down to 6 1/4, 6 3/8. But for the addict who loves to refinance, that's fun. But I'm not into the type of being a mortgage broker where I want to refinance people 2, 3, 4 times because it's not.
Just
I
keeps
don't think
adding
it's
up.
very ethically correct. I think you have to wait till you hit the rate that is longer term beneficial to you versus a short term benefit. And I think that right now, based on where, if you could flip my chart.
Yeah, take a look at what Timothy's saying before I get to that. It says he does analysis for NCUA data. Last quarter published shows large increases in mortgage applications, very large.
Huh. Yeah, last quarter with the I don't know if it's refis or purchases, or if that's a combination of both. But Debbie, yeah, Debbie, I haven't forgotten about you. But I mean, you look at here. I'm pulling up with one lender right now on a purchase. Rates are a little different purchase and refis for the most part, but overall, you're still looking at 6 3/8 on a $475,000 purchase, 5% down. So they've just been stuck in this 6 1/8, 6 1/4 range for the last, last year, it seems like. So we haven't had any big push recently, except that there's been a few days in September when rates went down into the 5.99, 5.87. They've been kind of flirting around with those high fives. But man, I think the average mortgage guy or average person would love to see the rates, solidly into the mid fives. Would be nice. But once again, right here, the problem is, you look at it to get to the low mid fives. We're looking at bonds improving by about 2 points, in terms of price discount right here. Because when bonds improve, these discounts get cheaper. This goes away, these costs. So, but for it to make a push, it just hasn't had. We haven't seen any type of really crazy economic news to push rates down further in a good chunk of time, if that makes
Oh,
sense.
what about on the other side, though, Pat? I mean, do you see read anything that says that even despite this rate cut, that there's some stuff bubbling out there that may even push rates the other way?
I haven't. The only thing I've seen in the last 6 to 8 months is the job reports have been miscued and just I believe, I just, in the heart of hearts, I think the job market is not as strong as people say it is. You know, the ones that are getting cut are the Microsoft, the high tech. I think they're in jeopardy of that. I see on Facebook, I mean, just as stupid to say this, but you see people on Facebook just talk about, hey, I applied, I can't get a job. But then you get people replying back, well, try fries or try this or try, I mean, those are $15, $16, $17 an hour jobs. They're not your high tech 80, 90, 100,000 hour jobs. If that
Well,
makes
he
any
also
sense.
announced today that they have stopped quantitative tightening and they're going to be purchasing treasuries at about 45 billion.
40 billion, 40, 45 billion. And that's where you could kind of certainly see, I don't know, they make announcements. Obviously the Federal Reserve, New York, they publish month to month what they're going to be purchasing, but who knows? I don't know if they could certainly do it quietly. You could see maybe we might have a day where bonds all of a sudden are having a nice little rally the next couple of weeks because all of a sudden they're purchasing their, the mortgage-backed securities. So they could certainly be doing that quietly behind the scenes.
Well, once again, it lines up to say, well, and just what he's saying, we don't see a rate cut coming next month. But then again, he's going, but we are doing some things that, that might lower mortgage.
Yeah.
But it's not going to, it's like, we don't have anything planned for January or February. So people are going to sit back and go, well, okay, I'll tune in March and April. I'm going to wait. And
I think rates will go down when you least expect it. The problem is they never go down when you expect it. They go down when you least expect it, and catches people by surprise. But I just think that there's more bullish signs for rates going down than up. We've got inflation kind of coming under control, even though I think it's much higher than what they always say. But you got to realize that he's going to be hiring. The next Fed chair is going to be obviously positive for rates. So what you have to realize too is that buy before the news, sell after. Maybe rates do. Maybe there is maybe a point to say that rates get better. January, February, Marchish, because we know that the Fed chairman's coming in May. That is going to have a positive impact, and the market's going to reflect that a month or two before.
Yeah, before he comes in.
Yeah, so you might see some movement. I think people ask me what I had a couple of people around the office say, "What do you think rates are going to do today?" He said, "Do you think they'll get worse?" I said, "No." And the owner of our shop, Andy, had the same theory that I had. The last 5 meetings, rates were getting positive, moving in a positive direction. Then they got slapped that day. This time it was the opposite, where they're getting worse 5 days. So it's almost like the market was kind of anticipating this counter mechanism, so to speak. And quite frankly, I can sit here and spew all I want about what rates and what's going on with the market. I know one thing. I listen to Powell. He doesn't know either.
Yeah.
So I got just as much of authority to talk about rates than Powell does. I don't know how they do it, but I just think that they've been behind the eight ball. And you listen to the financial experts out there. I think we're just going to be in a position where I just don't see rates really going up or down in a crazy fashion. We're going to be stuck in this range, but I would like to see them quietly float down in the mid to high fives, which they could do.
I did a prediction video yesterday, Pat, where we looked at all the big dogs like Zillow, Redfin, CoreLogic, and National Association of Realtors, and the growth for next year in sales, not prices, are anywhere from 1.7% to 14%. It's a pretty wide swing.
Yeah,
that's nationally. So and these are the people that crunch those numbers every day. They're not some Yahoo out in the East Valley with a spreadsheet, an MLS resource. Oh, that would be me.
Yeah. But you got to realize too, you got to remember though, I think next year is going to be, we were coming off last January, February, March, we were talking 7, we were looking at 7.25 for interest rates. Now we're talking 6.8, 6.25. So, and the thing with that, I've always said, I think it's good to have stable rates versus something that's going to come out and, excuse my French, bitch slap you into the face. It's like, whoa, what happened there? So rates have been stable, which is a good, as we always say, decision-making process. You know, what you want to do, you know, if you want to sell and buy, at least you know what kind of rate you're going to be getting. Would you like to be getting a much better, lower rate, like mid fives? Yeah. I just think like I said, it's been stuck in my gut the last year and a half that if we can get to the low to mid fives, that would be just a good landing spot.
Well, the Cromford Market Index is not showing anything trending. Like here's the index going up slightly, but they've been showing demand increasing. But this thing has been seesawing for pretty much the past year. So
Yeah.
you can't really say, well, it's not getting worse. It's not over 100. Supply, same thing, a little bit of a seesaw going up, but now with the holidays, it's coming down. So there is not any really like negative news. We just got a whole bunch of stuck in neutral, whole bunch of, well, here's where we are, probably going to be here a while news that we're seeing. Now, there's an interesting opinion.
Sounds like my dating life.
Yeah, you're stuck in neutral. And usually you do that 23 minutes in. Yep, you're within 2 minutes.
Yeah, 21 minutes.
Yeah,
Pretty good.
you say, folks, you can set your watch to that. Tina Tambour, I don't know if it's Tina or if it's Michael, or I got a feeling it's Tina, just because of the writing style. Kind of going after Melody Wright for a while, claims of doom. And she says investors are giving up and flooding the market with supply that no one wants. And she said, we don't see any data that backs up this view, at least as far as Greater Phoenix is concerned. So she goes on here explaining what it is we see and what we've got. If anybody wants to shoot me an email at rickhelps.com, I'll copy this, paste it, send it. But it's interesting. It's basically just saying, she could say it, I'm not seeing it. I mean, we're not seeing investors dumping homes. It's just not happening. If it was, I wouldn't be getting 3 or 4 text messages every morning with my coffee. Rick, do you have anything for me?
Yeah.
In fact, I was a guest speaker on Arizona Investment Club. It's an investment group. They had like 100 people on this call, and they're all, investors, flippers, and wholesalers.
You were a special guest?
I was a special guest. Yes, I was on to share Phoenix data because their regular guy wasn't on. I was kind of at a loss as to what they really wanted to look for. So I'm sitting here in front of my computer, 2 screens. I'm watching them, and fortunately for me, they got the Tucson guy up first. So he's showing them, and he's on every week with them. So he's showing them all their Tucson data. And I better pull that up for Phoenix. Let me get that. All right. He'd show on the other side. Oh crap. Let me find that. So by the time it came to me, I was well prepared.
I concur with the guy down in Tucson.
Yeah. There you go. Let me show you that exact same number. But my point is there's a lot of investor activity that's out there that has still lingering between 13 and 17%. It hasn't changed. No, they're not dumping them. No, we're not seeing short-term rentals being dumped. That's a community by community thing. But I will end and say that condos are getting beat up bad.
Yeah.
If I go back to condo prices here, price per square foot, and I just select condos, you can see that the price per square foot came down considerably, and especially under $500,000. So they've really taken a nosedive compared to single family residences. It's almost flat after the big return. So it's removed the condo. There it is. So it's kind of flat. Put the condos in, they're pulling down the rest of the market. And if you own a condo, you know that. And so even in that number, so you can see that condos are getting beat up. And some of that is because the condo association can rewrite the rules about short-term rentals, Airbnb. And if it's not conducive for them to own an Airbnb anymore, they're putting them on the market.
And they're getting slapped around with insurance and HOAs increasing everything across the board.
Yep, that's what's happening. Well, Pat, hopefully we'll see you next week. I think I don't have anything. Let's see. What is the date next week? 11th. That's the 18th.
18th. Yep. Hopefully be on.
Hopefully be on. Yeah, I'm having.
Yeah, next week we've got. I mean, going back to that, with the federal fund rate, will the rates change? Blah blah blah. I mean, next week we've got. I'm looking at the schedule. We got ADP employment change on Tuesday. We've got building permits, retail sales coming out, and then we got slew of news. All this news that comes out week to week to week can certainly change mortgage rates. You've got retail sales on Wednesday. You've got some Federal Reserve, Fed Bostic is talking, and then you got the CPI on the core CPI for November coming out December 18th. So I mean that certainly could be something that shakes up. And then Friday, December 19th, the core PCE month to month on October and November. December 19th, Friday. So December 18th. Let's see, it's weird. Month to month core CPI. November, and then there's Thursday and Friday of next week, you have the CPI numbers. So
this whole month, Pat, is just going to be a month of data setting us up for January, because it doesn't really matter what we're seeing in home sales and inventory right now. It doesn't matter, except I'm on my high horse saying, don't pull your house off the market if you're listed. Let everybody else do it. Like Jackie said, they got 3 contracts this week. So
yeah, you're gonna have. I mean, certainly you got less you got less supply, less inventory out there, and the people that are looking to buy, there are still people out there looking to buy. So
yeah, you have nothing to gain by pulling your listing and putting back on in January, because everybody else is going to be back out there the second week of January. Right now, you're seeing your neighbors take sign down. Good. Okay. The other part of the market that's getting flushed out pretty bad too is the over 55 communities. And I don't have access to it, but my brain tells me that's all Canada.
Yeah.
So that's, they've decided to take advantage of the dollar difference. They're like, their dollar's worth 71 cents. So if they bought 2012, and a lot of them that bought in 2012 too, right now are selling to go back to Canada because they're getting older and they just want to, go back to home instead of have 2 residents, and there's nobody behind them filling in at the numbers that we had. So they're only 1.3% of our total market, but much higher than that in our over 55 market. So there's an impact there. And where there's an impact, there's opportunities for people. If you're from out of state and you're considering coming to Arizona, take a hard look at what's happening to pricing and inventory in over 55 areas. They're getting clobbered. And that's when you want to buy, when everybody's getting clobbered.
Yep.
And again, that's just in a retirement community. So it's a whole different animal. So,
all righty, well, we'll see you.
Right. We'll see you next week. Till then, have a fabulous weekend.
Thank you, everybody. Our millions. Bye-bye.
Millions of you.